Something major is unfolding at this moment, and the world's leading banks are quietly briefing their richest clients through exclusive research reports. Yet almost none of this information is reaching the everyday people who need to hear it most. We're talking about Goldman Sachs, UBS, and JPMorgan. In just a 48-hour span, all three released reports that aligned perfectly. Same direction, same asset, same fundamental change, and the same outlook on the direction of the global monetary system and its impact on the buying power of every dollar, euro, and pound that regular folks have worked hard to save over their lifetimes. I've got copies of those reports. I've gone through every page in detail, and over the next 20 minutes, I want to break them down for you. Not just give a quick overview or highlight the comforting bits, but truly unpack what these major firms are sharing with their biggest clients, why it should matter to you personally, and what the alignment of central bank actions, big institutional moves, and government policy shifts reveals about the monetary reset that's already in motion. Let's begin with the key term in the title, devaluation. It's one of the most critical economic ideas out there, yet most people don't fully grasp it until they've already felt its effects. Devaluation doesn't need some big public declaration. It doesn't need shocking headlines or a stock market meltdown. Instead, it unfolds quietly and steadily, affecting anyone who keeps their wealth in something that can be produced without limit. Your savings account might offer 4% interest. If you're banking with one of the big retail institutions, it's probably closer to 1%. At the same time, the official Consumer Price Index indicates prices are climbing by about 5% each year. In practical terms, looking at what your saved dollars can actually buy, you're falling behind every single month. This isn't due to a market collapse or a poor choice on your part. It's because the entire system is designed to shift purchasing power away from savers and toward borrowers. And the biggest borrower on the planet is the very government that prints the currency you're holding. This isn't some fresh insight, but it's now more pressing than ever. The urgency stems from what Goldman Sachs, UBS, and global central banks are actually doing with their own money, rather than what they say in their official public comments. Let me go through Goldman Sachs's stance first, since it's the clearest and most straightforward. Goldman Sachs stands out as the investment bank with the greatest influence on how large-scale institutional money moves. When their top commodity experts issue a report calling their outlook on an asset constructive, the professional term for bullish or expecting prices to climb, that kind of note can shift real money around. Portfolios get rebalanced, allocations change. So when they use the word constructive in a note released right after a 12% monthly drop in an asset, it signals that the dip hasn't altered their thinking. They're still in buy mode. That's exactly what they communicated about gold following its weakest monthly showing in 13 years, a drop that led many everyday investors to think the whole gold story was finished. Goldman's team directly ties their positive stance to three key elements: ongoing inflationary pressures stemming from the Middle East tensions and their impact on energy costs, the Federal Reserve's limited ability to slash rates sharply amid that inflationary backdrop, and the long-range fiscal path of the U.S. government, which is spending far beyond its means at a pace unmatched in modern history, except during major wars. The fiscal side is what I want to focus on, as it's the bedrock for all the rest. Right now, the United States government is carrying a national debt exceeding $38 trillion. The yearly deficit, the gap where spending outpaces tax income, is running around $2 trillion. Interest payments on the existing debt have grown so large they've overtaken the entire defense budget in the federal spending plan. This isn't some distant issue on the horizon. It's happening today, and it sets firm limits on how monetary policy can respond going forward. When a government consistently spends much more than it brings in through taxes, it basically has two ways to bridge that shortfall. One is borrowing, issuing more debt and paying interest to those who purchase it. The other is monetization, directing the central bank to generate new money and use it to buy up government debt. In other words, printing money. Borrowing works for a while as long as the interest costs stay reasonable compared to government income. But once that interest load gets too heavy, as it already has, leaders face a tough call. Either push through painful spending cuts and tax hikes that voters won't accept, or turn to monetary easing that slowly chips away at the currency's worth. Every major developed nation is going with the second option. They're opting for inflation instead of tough cutbacks, and they'll keep doing so because the political fallout from the other choice is simply too much for elected leaders to handle. That's the core reason Goldman Sachs remains constructive on gold even after that 12% drop. It's not about chasing a quick trade. It's driven by a simple math problem that can't be fixed without a prolonged stretch of currency weakening, which is exactly what devaluation refers to in this video's title. Shifting now to UBS and the message they're delivering to clients. The viewpoint from Switzerland brings a valuable extra layer to what Goldman laid out. UBS points to four main forces supporting gold right now, and I want to cover each one because, taken together, they paint a full picture of the underlying pressures at play. The first is the threat of stagflation. This is the tricky situation where prices keep climbing while economic growth stalls out at the same time. Basically, the worst mix imaginable. You end up with inflation, but without the usual boost in activity that comes with it. It's a scenario the Federal Reserve struggles with most, since its main tool, adjusting interest rates, ends up fighting one issue while making the other worse. Lower rates to spark growth and inflation picks up speed. Hike rates to tame inflation and growth drags even more. The central bank gets stuck with no good moves. And looking back at past stagflation periods, especially the 1970s as the clearest case, gold stood out as one of the top-performing assets. Why? Because it sits outside the broken monetary setup that's struggling to keep prices steady. UBS is directly highlighting stagflation as a real and probably underestimated danger today, fueled by energy cost spikes tied to Middle East developments, plus broader slowdown pressures from tariffs, global divisions, and tighter lending standards. The second factor UBS highlights is potential dollar softening. For decades, the dollar's special reserve advantage, the extra demand it gets beyond what U.S. economic basics would suggest, has been the main force keeping gold prices in check. A strong dollar makes gold costlier for buyers using other currencies, which dampens worldwide interest. But when the dollar eases, gold feels more affordable to most people around the globe, opening up broader demand. UBS expects the dollar to lose ground from here over the medium term. This outlook rests on the same fiscal pressures I've mentioned: ongoing big deficits, the chance of more money printing, and a slow fade in trust toward the dollar's dominant role as countries watch how dollar-based assets were used against Russia and rethink the dangers of relying too heavily on it. The dollar doesn't have to crash for this to count. A steady, multi-year slide, the sort that doesn't make big news but steadily eats into buying power, is enough to give gold a strong structural boost. The third element involves declining interest rates. This might seem surprising right now, since inflation is keeping the Federal Reserve from cutting rates in the short run. But UBS is looking further ahead, not at the immediate picture. The debt math I outlined, $38 trillion in climbing, widening shortfalls, interest costs topping defense spending, builds pressure that persistently high rates simply can't support forever. Eventually, that burden grows too heavy to bear politically or economically, forcing the Fed to ease rates despite lingering inflation. UBS's experts see this coming within their medium-term time frame. When it does, real yields on dollar assets drop, and lower real yields shrink the cost of holding gold, which has no yield of its own, taking away the main near-term reason to avoid it. The fourth and most important long-term factor is buying by central banks. This stands as the biggest structural shift in the gold market in recent years. Data from the World Gold Council shows central banks worldwide bought more than 1,000 tons of gold last year. This isn't some one-off spike. It's part of an ongoing pattern that started gaining traction around 2010 and picked up sharply after 2022. Gold now makes up roughly 20% of reserves for emerging market central banks, a share that would have been hard to imagine 10 years back. And these buyers aren't acting on some forecast model predicting price gains. They're diversifying away from a reserve setup that proved vulnerable when Russian assets were frozen, showing it's influenced more by politics than consistent rules. This represents the strongest and most lasting support for the gold case overall. The dollar earned its reserve position through trust, the belief that U.S. authorities would treat foreign holders of dollar assets fairly, no matter the political ties between the countries involved. That foundation of trust has been fundamentally damaged. It won't be rebuilt overnight with a speech or a handshake. The example has been set, and now every national treasury and central bank has updated how they weigh the risks. I also want to tackle an issue that's crucial for anyone puzzled by gold's recent price action. Gold just posted its poorest monthly result in 13 years. If you're holding gold, you felt that pullback. So the obvious follow-up is, does this shake up the overall case? Is that 12% drop revealing something the analysts at Goldman and UBS are missing? Answering that means looking at the real cause behind the drop, not the surface story. What happened was a liquidity squeeze, not a rethinking of gold's underlying worth. Here's the sequence. Middle East developments sent oil prices surging, triggering paper losses in nearly every asset category except energy itself. Hedge funds, often running with heavy leverage, sometimes 40 times their actual capital, got hit with margin calls on their holdings. When you're leveraged that extremely and even a modest move goes the wrong way, the hit to your own equity can be devastating. You suddenly need immediate cash to cover those calls. And in those moments, you sell whatever can be unloaded fast and in volume, not necessarily what you'd prefer. Gold ranks among the most liquid assets globally. You can sell large amounts right away, around the clock, in any market. So these leveraged players offloaded gold not because they thought it was too expensive, but because it was the easiest way to raise cash during that stressful portfolio crunch. Think of it like this homeowner analogy. Someone who loses their job doesn't sell their house because they suddenly doubt its value as an investment. They sell because they need the money now. The house itself, its location, build, surroundings, hasn't changed at all. Only the owner's cash situation has. Gold played that same role here. The sellers weren't signaling doubts about gold. They were just addressing urgent liquidity needs. You can see proof of this in the physical market numbers. While paper gold prices were falling and COMEX futures saw heavy selling from those leveraged funds, the actual physical gold stocks registered in COMEX vaults were dropping too. Real metal was moving out. Requests for delivery were running high. If this had been a true fundamental rejection of gold's value, you'd expect physical buying to slow down as well. But the opposite happened. Buyers seeking the real thing, not just paper claims, stepped up their purchases at the discounted levels. So the paper side screamed panic, while the physical side whispered opportunity. That split between paper trading and physical reality is one of the strongest telltale signs in the gold world, with a track record that holds up over time. When paper prices drop but hands-on demand picks up, it usually means the paper market is undervaluing the asset compared to its true supply and demand picture. That kind of disconnect can't last forever. In the end, the physical reality takes over. Next, let's talk about the China angle, which may be the single most significant shift in the gold market that mainstream Western outlets have largely overlooked. Chinese regulators recently greenlit an initiative allowing 10 major insurance firms, including PICC and other giants handling trillions in renminbi, to put as much as 1% of their total holdings into gold. UBS experts who visited China to evaluate this found that inflows into Chinese gold ETFs stayed strong even as North American ETF flows turned sharply negative. Activity on the Shanghai Gold Exchange rose, and the insurance allocation scheme hasn't hit its cap yet, so not all the approved money has moved in. That 1% slice from China's big insurance companies alone points to around $27 billion in possible gold buying. And that estimate might even be on the low side, since the program could grow to include more players or raise the limit once it proves itself. This isn't some quick flip. Insurance companies rank among the longest-term investors anywhere. Their planning stretches across decades. Once they establish a gold position, they tend to keep it through short-term price swings. They maintain it and often build on it. That kind of steady, patient physical buying is exactly what short-term paper market swings struggle to override. What's playing out is a clear shift. Western paper traders selling off, while Eastern physical buyers accumulating. It's moving gold from high-leverage, quick turnover hands into steady, unleveraged, long-term ones. With each shift like this, there's less gold left that could be dumped under pressure later, and the group of dedicated long-term owners gets bigger. The effect on upcoming price behavior is pretty straightforward. Now, here are the 3 key questions I find most helpful when sizing up any major investment in today's setting. Not only gold, but any important portfolio choice. The first asks, what are the best equipped, most sophisticated institutions on the planet actually doing with their money, separate from their public comments? Words and deeds often don't match. Official statements usually aim to shape opinions. Real money decisions show true belief. The current answer is crystal clear. Central banks are snapping up gold at the fastest steady rate in decades. Chinese institutions are putting together their biggest gold positions ever via an official program that's barely been noticed in the West. Goldman Sachs is staying constructive on gold despite the 12% drop. UBS is advising clients to remain positive. These aren't just views, they're real, trackable moves in capital and formal research from major players. When outfits with the sharpest research teams and longest time frames all zero in on the same asset at once, it warrants close attention. The second question looks at what the broader crowd is doing and what that says about the current mood cycle. Individual investors dumped stocks and gold heavily during the height of the turmoil. Sentiment gauges hit very low, fearful levels. That's noteworthy not because retail feelings accurately forecast moves, but because such heavy selling creates the conditions for the next swing by clearing out potential sellers. Once nearly everyone who might sell has done so, the next buyers set the direction. And in this case, those next buyers are the big institutions that were positioned to pounce on exactly this kind of liquidity-driven sell-off to load up at cheaper prices. Data from JPMorgan itself indicates that whenever U.S. stock positioning has reached bearish extremes like we see now, the S&P 500 has historically returned about 8.2% on average over the next 3 months. That's just a past average, not a sure thing, but it highlights how sentiment mechanics work in markets. Deep gloom and strong rebound potential often line up. The third question checks whether the big drivers behind this idea are temporary or enduring. Will they strengthen or fade in the years ahead? The core supports for the gold outlook, runaway government spending, currency weakening, moves away from dollar dominance, and countries diversifying reserves aren't short-cycle phenomena. They didn't start with one decision and won't end with another. America's budget shortfalls come from deep-rooted spending promises and limits on revenue that have built up over decades. The push to reduce dollar reliance stems from geopolitical facts, like the use of dollar assets as a tool which can't be reversed with nice words. China's insurance gold program is a policy choice that will keep growing as it rolls out and possibly widens. These are forces aligned over multiple years, each reinforcing the others. The reset now taking place isn't really about markets, it's about money itself. The slow but steady loss of value in paper currencies compared to hard, limited physical assets is how governments ease the conflict between their massive debts and their reluctance or inability to cut back on outlays. This pattern has occurred many times before. You can trace it through the long history of every major fiat currency over decades, and the smart institutions that recognize how it works are quietly and methodically shifting their holdings into assets that hold value through these periods, at the better prices created by temporary volatility. In a monetary reset, the ones who suffer aren't those who picked the wrong investment. They're the people who left their savings in the very thing losing value: cash, bonds, bank accounts. Meanwhile, those who saw it coming moved discreetly into holdings that preserved real wealth throughout the weakening process. Grasping how this works is the initial step toward staying on the right side of it.